earlier this week. Lawrence had something come up and wasn't able to join us today, but we do have another incredible person. She's a senior economist with NAR, so she's going to be sharing kind of what it looks like now that California is reopened and Silicon Valley is making a strong comeback. But we are going to start with Dave Campagna. For those of you that don't know, he's with Premier Lending. He is a staple at the CBVA meetings, giving amazing housing stats and really sharing his knowledge and wealth of information. So we're going to get started with Dave. And if you have any questions, please use the Q&A box at the bottom to put your questions in there, and we'll be able to do a few of those. And then we'll jump into our economic outlook. So Dave, I'd like to welcome you first and thank you for being here.
Thank you very much. I'm going to go ahead and share screen. And when I do the CBVA meeting and, took my lead from our CAR president, Dave Walsh, as you all know from Compass, we've always kind of done areas 1 through 19. So that's, Gilroy through Cupertino, basically. So it's just kind of the south end of the county. And so everything that I present is going to be based on that. So I'm going to jump right in and just kind of show you where we're at for the marketplace, basically live. And what I mean by that is I ran these stats at about 6:30 this morning. So first thing I'm going to bring up is the current active inventory of what we got going on. So in areas 1 through 19, on single families, we have 760 single family homes available for sale. And I know if we look year over year, and it's starting to be less of an effect on that because of when COVID started and such, I always like to look back to a rolling quarter. So I'm going back 12 weeks and averaging all 12 weeks. So if you average the last 12 weeks, we can see that our inventory levels are actually trending up a whopping 7% or 50 units when we look at the single families. And I do the same thing with the pendings as well. And with the pendings, we're actually seeing slight decline, 30 units off or 3%, sitting at 1125 as of this morning, homes that are pending right now. And over the last 12 weeks, we've been averaging 1155, nothing to worry about, but just to kind of let you know where we're trending in regards to that. And then when we look at as our local MLS will say, our class 2 properties, not that they're subpar, but, a single family is a class 1, right? So when we look at our condos and PUDs, those combined, we have 412 opportunities. So a whopping 1% or 3 units more than when we've been trending for the last 12 weeks in regards to that available inventory. When we look at our pendings in that category, they're actually up 11 units or 2%. And if you combined all those numbers together, so if you're walking around in your grocery store and someone says, hey, in general, what's going on in the market, you can kind of just tell them the overall changes. As far as inventory is concerned, we're actually up 5% or 53 units. The pendings are pretty much flat or only off by 1% when we look compared to the last 12 weeks. Now, I know a lot of people like to know, okay, well, what's really going on with prices? Because that's units. Now let's talk about dollars, right? Let's see what we're doing. And as I like to say, and as I present on the first Wednesday of every month at the CBVA meeting, let me give you your report card for the prior month. So since we're sitting in June, let me get you May's numbers. So to start off with, I'm going to do, I apologize, I'm out of order. I want to go hyper-local first on those inventory levels because while somebody may be buying in the greater San Jose area, they're probably looking in a certain neighborhood. So let's go through some of the neighborhoods that we report on a regular basis and just see how things are different throughout the greater San Jose area. So we're going to start with numerically Area 1, which is South County, Gilroy, Morgan Hill, San Martin. This week we have 111 opportunities for single family only. So it's +7 in regards to inventory or 7% difference. So right on par for what we were seeing for all the rest of the numbers. When we look at Evergreen, and it's funny to see it as a percentage, oh my God, Evergreen, they have 52% more inventory because they have 16 more units compared to the 12-week average sitting at 30 versus 46. As we look at Central San Jose, which would be your downtown, Area 9, Megley Park, and Rose Garden areas, it's absolutely flat. So our 12-week average is 53. This week we're at 53 as well. As we look into Willow Glen, their inventory dropped by 4 units or 8%, sitting at 47 versus 51. Blossom Valley, a little bit of a change there, down to 30 units there. 12-week trend was 41. So we're off 11 units or 27%. When we look at Almaden, it's +7 or +21% as you look at it as a percentage for the Almaden area. When we look at Cambrian, they're +5 or a difference of 12%. Campbell is next at +3 units or 7% versus the 12-week average. Then we go on up to Los Gatos. Los Gatos is a +5, and we're going to round it out with Saratoga. Saratoga is sitting at a +4 or 12%. So as you can see here, all of the areas are up with the exception of Willow Glen and Blossom Valley have a negative trend in regards to inventory available, and then obviously Area 9 is at a dead even compared to the last 12 weeks. So as you have people that are looking in different areas, you kind of know what is happening. Now I want to go into the closed report as I started to say before, and the closed sales is going to be for last month. So let's go ahead and bring that on up. So we're going to use those same marketing areas. So I didn't list all the ones for current inventory. So we're going to do our closed sales for areas 1 through 19, single family only. We're going to combine all those together to kind of get an average list price and everything else. So let's go ahead and see what that looked like. In the month of May, we closed 1,022 sales. We listed them for 1.643. Took 11 days for that to go pending. Our close price was at 1.8. And just so you know what the average home in the greater San Jose area, that's a 1,987 square foot house on a 12,000 square foot lot. I know a lot of people out there going, there's not a lot of 12,000 square foot lots out there. But yes, remember this at South County, where you could be on something that's an acre. That's going to bring that average on up. Our price per square foot sitting at 947. And no, you don't take 1.8 and divide it by 1987 square feet. It averages each individual one when I run this through MLS, and then it gives me the average price per square foot. So it's not as simple as math as what you see on the screen. So did we do good? Did we do bad? Are we status quo? Are we even? Are we plus? Are we minus? Well, let's bring the year over year numbers so you can really see what that looks like. So when we look at May of 2020, there's a dramatic difference in the amount of units that sold. But remember, we were just trying to figure out, how do we sell homes in COVID with no open houses? How do we see them? What the heck is a PED form, right? As we go back and look at things. And when we're looking at this, let me bring the math up for you so you don't have to do it in your head. And you can see the differences, right? So our list price went up 14%, or $197,000 on average list price. Our average close price went up 24%, or $348,000 year over year. Now, I would take this with a little bit of a grain of salt because, as I said, when we look at mostly like April and May of last year of 2020, we were just starting to figure out how to sell homes again with limited availability of how do you actually show these houses, right? And, by the time you got into May, you were starting to become a pro at it, but May sales closed in June, right? So when we get back to June's numbers next month, we'll be able to see a little bit more of a comparison to how we're doing business, right? When we look at this too, just to kind of put that in a little bit into perspective, I don't have it on the screen, but to narratively tell you the month over month difference. Oh, actually, let me bring up these numbers first as well so I can do some math with it. So when we look at that list price versus that close price, just so you know, that's 108.8% of asking. And when you look at the percentage of increase of how many sales we did, which I think is artificially high, that's a 55% increase in amount of sales when you look at the year over year. Now, when you look at month over month, and I'm not going to have it on the screen, it's just going to be an oral for that. We had 1,022 sales in May of 2021. Well, in April of 2021, we actually had more. We had 84 units more, or 1,106 happy buyers and happy sellers in the month of April. So it's an 8% drop in units. So remember, you read past the headline, right? So we had 8% less sales. But here's the interesting thing. The average price last month was 1.735, or $65,000 lower than when we were in May, which is a 3.5% increase in 1 month. Now, that's just the single families for areas 1 through 19. So let me go ahead and bring you the condo PUD market, because a little bit different market for that. Got off to a slow start when COVID started, because people wanted to be more separated and not be in a building that may or may not have an elevator or have a connected wall. And with this sheer price increase of 24%, some people just got priced out of the single family market. So we're starting to see those pick up. So when I bring you the closed sales for May of 2021, we had 433 happy buyers and sellers. They took 19 days on market. You can see that the average list price was $887. The average closed price was $933. That home or condo or a planned unit development or PUD had an average square footage of 1347. And as you can see, the lot size being small, especially if you're townhouse style and you're stacking, right? The lot size is 1436 with an average price per square foot of almost $700, missing it by $1. So as I stated before, how did we do year over year? So here's the year over year numbers. We only had 137 last year. So a blockbuster, hey, let's just buy whatever we can kind of thing, in my opinion. And we see that our average list price went up 8%, average close price went up 15%, or $118,000, right? And our price per square foot up $87 to $699 from the 612. So in regards to the month over month on that, when you compare May of 2021 to April of 2021, again, just giving you a narrative, we had 510 units. So again, we saw a little bit of drop in regards to the amount of units sold in April versus May. And so that's 77 units, or a 15% drop month over month. However, just like the single families, the average price was $960. So it was 906, 960. That's the numbers on it, or 26,000, or a 2.9% increase. So just not that far off. Only what 0.6% differential between that and what the single families did in regards to the condo PUD market. In regards to that, moving along, I wanted to highlight, the percentage of asking that you got on that. So when you look at the percentage of asking, it was 105% of asking in the month of May, from list price to close price, and then obviously a 68% increase in sales. Now, as I normally do, and Gay, you'd be happy to hear that I include a lot of stats from the National Association of Realtors, but this time I stripped it all out because I want to make sure that you're the star. So I did grab some other national news, because I know all consumers, when they're going through the process, always think it's about themselves. It's about me. Any headline I hear, it's about the house I'm buying, and they don't really know what the headline is. So I wanted to bring you a couple of headlines that had nothing to do with the National Association of Realtors, because everybody collects data a little bit differently. But I wanted to make you aware, because people will bring up statistics and they could be a week or two old. In fact, this one is about 10 days old. And this one is coming from CoreLogic. So CoreLogic will put out their report, and they say home prices nationwide are up 13%. And it's the highest record annual growth since February of 2006. And I thought that their chief economist had something interesting to say. And they said baby boomers are staying in their homes longer, slowing the pace which existing home sales come on the for-sale market, resale market, right? Owner occupants today have been in their homes for a median of 13 years, about 50% longer than previous generations, right? So it's interesting, people are staying in their homes a little bit longer. The other thing I thought I'd bring you, even though we all know in our small little corner of the world of Silicon Valley, that things are going gangbusters, proven by the numbers I just gave you. But I thought it'd be interesting, because a lot of people say everybody's moving out of state. Well, for everybody moves out of state, we got people moving into state, right? Because we know how many sales we just had. I just showed them to you. But according to CoreLogic, here are the top 10 states that had appreciation change. Idaho being number one at 27%, Arizona at 20%, South Dakota tying pretty much with Montana. And then you've got like a four-way there going with Utah, Vermont, Indiana, New Hampshire, all at 18%. Rhode Island and Washington sitting at the mid 17s in regards to that. So one of the other things that's on a lot of people's minds, just to kind of keep up with some national stuff, is hey, what are rents doing? And we know locally, when we look specifically like to our neighbors to the north in San Francisco, that the rent prices kind of plummeted. And you can find that statistic in a lot of different reports. So these are going to be national numbers, again, for rents. And we can get that from a lot of different places. And it's no wonder that the consumer is confused, because I'm going to show you 3 different ones from 3 different places with 3 different numbers to put it in perspective. Because naturally, if I'm a homeowner and my value of my house went up, I'm gonna keep the rents going up, which is another advantage of buying. You get a 30-year fixed rate mortgage, your payment stays the same all the way through, and house prices happen with appreciation and inflation and everything else. Well, with house prices going up, everybody's worried about inflation. There's gonna be more on that in just a second, but let me tell you about the rent thing. And I have a typo in there, and that's supposed to say the Consumer Price Index, or CPI. They have that as part of the component, right? That's an inflationary number. They say rents are up 2%. That report came out last week, and that was a blockbuster number into the 3s, and a little bit more on that in just a second. According to Zillow, they say rents are up 2.3%, but our friends over at CoreLogic, they say rents are up 5.3%. So which the heck is it? Who knows? We all just know that none of these are negative numbers. None of these are flat numbers. They are increasing numbers. And we know with inflation, housing prices will continue to rise, and the cost of that rent will continue to rise as well. Thus, buying a house today and fixing that in with a 30-year fix may be a very wise decision, not only from an appreciation standpoint, but it's not going to move. Now, shifting gears a little bit into lending and what's going on with that, just a couple of slides on that. I always bring something that is constant and consistent. Obviously, I'm a lender, but I'm not going to talk about my company. You're here to get knowledge from the Santa Clara County Association of Realtors, so I take myself out of it. I always present, again, what our consumers are seeing. Every single Thursday since 1971, Freddie Mac does a rate survey, and they put it out, and their headlines is something that goes into the news feeds, and sometimes people read it at 8:30 Eastern Standard Time, and sometimes they read it like a week later, like we kind of are, right? There's a new report coming out tomorrow, but if you Google what the rates are doing, even though it may not come from Freddie Mac, but it might be syndicated by somebody else, it's their report they're usually referencing, or the one from the National Mortgage Bankers Association. I just stay steady with Freddie Mac, so it's consistent, so we can see what the differential is week per week. So their economists are saying the economy is recovering remarkably fast as the pandemic restrictions continue to lift. Economic growth will remain strong over the coming months. Despite the strong economy, the housing market is experiencing a slowdown in purchase application activity due to a modest high mortgage rates. Now I'm going to pause right there. Now, the Mortgage Bankers Association are the ones that do that statistic. And if you look at theirs, they come out every single Wednesday. It's off by 2%. Now, is 2% meaning that everything's falling apart? No, 2%'s hardly anything, in my opinion, right? However, it's yet to translate into a weaker home price trajectory because of the shortage of inventory, as we all know, continues to cause pricing to remain elevated, right? So that's what they're talking about, what's going on in the housing market. Here's what's going on in the rates week over week. They said for the week it went down 0.03%. We'll have a new report out tomorrow. Remember, this is already old news, because the report that's coming out tomorrow is based on a survey they take on Monday and Tuesday. They compile it on Wednesday. They release it 8:30 Eastern Standard Time on Thursday. So by the time they release it, it's already old news, right? Because we're very aware that the rates may change on a daily basis based on different economic news and different people that are putting out things. Speaking of which, we have a prominent person that will be speaking today. Today is what we call Fed Day. So Jay Powell, or Jerome Powell is his official name. He is our Federal Reserve Chair, and he'll be talking at in about 8 minutes from now at 11 o'clock our time. And what everybody's going to be listening to, and I say everybody, it's the traders, right? So it's going to be the stock market, the mortgage-backed securities, the treasury bills. They're going to be looking for cues for him on inflation, because his job is to keep inflation at around 2 to 2.5%. It's kind of what their federal mandate is. So their press conference starting at 11. We want to key into what's their take on inflation, because that CPI report that I talked about, the Consumer Price Index, that was a blockbuster number in the last 2 months in a row, up over 3 to 3.5%. I'm sure that Gay will probably go into a little bit more about some of those national numbers too. So we're going to want to know what's going on with that, and what's their take on maximum employment, like where is that measured at, because our unemployment rate continues to rise, and it'll also be listening for their reduction in buying treasuries and mortgage-backed securities, because they've been inflating the market or making it stable. I shouldn't say inflating. They've been keeping it stable by buying to make up for it, to try to tame interest rates from rising, which naturally happens with inflation. So that's my presentation. If you want to write it down, I'm going to flash my email address on the screen. You can email this. I'd be more than happy to get anybody those slides. Jody, I don't know if there is a chat feature we can put that in, but you can just email me, dave@premierlending.com, say, hey, can you give me the slides for the day? Sometime today, possibly tomorrow, I'll be more than happy to PDF them out to you guys. And that's kind of my presentation for today, and really excited to hear Gay's presentation. So thanks very much for watching, and I'll turn it back on over to you, Jody.
Thank you. I saw somebody raise their hand, but we can't unmute. So if you want to put your question in the Q&A, I don't think you have this quite yet. Maybe you can get it ready by the end. But somebody asked if you had from January until now, maybe just the change in the uptick and where we're at from the beginning of the year.
In regards to what?
Sale prices from January until now, like what percentage?
So you want to know what the average close price was in January, single families areas 1 through 19 to what they are today?
Yes.
I can do that and show you what the percentage increase is over the last 5 months.
Okay.
Be more than happy to do that.
Okay. I'm going to ask one more question, and then we're going to bring Gay on, and then Dave will have that number towards the end. So the question is there a measurable impact on private equity entering the home purchasing market?
That's a really complicated. Is there a measurable impact on private equity? Oh, okay. So if people want to take advantage of their equity, I don't know where they're leaning towards that, but I would agree with you. There is. In fact, 95% of homes in the entire United States have more than 10% equity. 87% have 20% equity, and 34% have no mortgage at all. And in comparison to 2009, 26% of homes nationwide were actually underwater. So there's only 1.6% of homes that have no equity right now. So are people pulling cash out to buy a vacation home and a rental property? If that's your question, Fannie and Freddie made it a little bit more difficult to do that, which caused price to go up on rates for that by limiting how many loans any individual can sell directly to them. So that has a little bit of impact, but I'm sure a lot more people would like to, including myself, would like to hear Gay talk rather than me talk. So I want to cut it right there and give the floor to Gay, because I know she's got a limited amount of time. So if you, hopefully that answers it. And then real quick at the end, I can put it in the chat to Jody as far as that percentage and dollar amount change, so that we don't have to bring me back on the screen and we can give all of our attention to Gay.
Perfect. So thank you, Dave, for all of that information. And again, he is a staple the first Wednesday of the month at CBVA with those amazing stats. But I do want to introduce Gay to everyone. She is a senior economist and the director of housing and commercial research with this research group at NAR. She manages the production of NAR's proprietary housing, commercial, and international statistics, surveys, and research. Her research focuses on the effect of economic, demographic, and industry conditions on the current trends and outlooks on the residential and commercial property market. So she's the perfect one to be stepping in for Lawrence this morning. We thank you so very much for being here. And again, if you have questions, we'll save them till the end and put them into the Q&A box. So I'll turn it over to you. And I know you're going to share your screen with us, but you got to unmute first.
Unmute.
Perfect.
And I just had to insert one extra slide about vacation homes. I'm looking at my report. I don't have it.
You know, it's interesting.
Oh
I did get something from NAR.
I was like, do people vacation in San Jose or Santa Clara? Maybe they go elsewhere. So I didn't think it was relevant. But hey, yeah, you're right. You know, you buy homes elsewhere, right? To vacation. Okay, let me now share my screen. Share. Where do I see this? What am I sharing? Do you see what I'm sharing?
Yeah, we see the weekly report.
Oh, no, that's not it. Hold on. Sorry.
No problem.
Okay, hold on. Let me share again.
But I did see something
There
about
it is.
vacation homes and like Arizona, North Carolina, places like that, Vermont.
Okay,
Yeah.
so that's it, right?
Yep, we got it.
You got it. Okay, thank you so much. And well, I'm glad I'm following Dave because he really pumped up today's today's webinar. And wow, that was just a surprise to me. 300,000 more in listing price from a year ago to now. 105% more. The sales price is about 105% more than the listing. Wow. Okay. Well, let me. I hope you don't find my presentation boring after Dave. Okay, let me just, I guess, start with where we are, kind of give you an overview of the economy because the economy drives the housing market, right? If the economy is bad, housing market will tend to go down because people don't have incomes, they don't have jobs. And of course, incomes and jobs are important when buying a home. So GDP, we all know that word, gross domestic product, GDP, but it's a measure of economic production. And we can see that we're almost there. So the economy is recovering just about, I think this is just about a 2% drop now, but we've had a pretty amazing recovery, a quick rebound because of the support of the Fed. And Dave just talked about that, right? In a few minutes, Chairman Powell will give his what do you call that? Most watched statement. What's he going to do to interest rates? Because really, the easy monetary policy and the fiscal support, which is filtering to the economy through your unemployment insurance checks, through your the $2,000 that we got, probably that's a nickel for people in the area, but for most people everywhere, that matters. But anyway, so there it is. The economy is solidly recovering. Although the pace of the employment recovery hasn't been that fast. I mean, it's been fast, but I guess what I'm trying to say is the gap there between the level of employment prior to the pandemic and now, employment is still down by 7 million. So not quite recovered yet compared to the pace of recovery of the economy, which is measured by GDP. And why is that? Well, it's because we're still in the throes of the pandemic. The economy is starting to open up, but we still have all this, kind of like social distancing regulations. Some people are still hesitant to travel. We're still observing social distancing. So 2 million of those 7 million jobs that I had mentioned are coming from accommodation and food services. Those are where the job losses are. Also your local government. Now, if you look at the bottom of the screen, and actually I can't see at the bottom, but I do remember, so professional and technical services are up, as though a lot of the jobs in the Santa Clara area would be in this area, right? So those jobs are up. Dave's jobs profession, lending, that's also up because of the boom in the housing market. So those are the, and then there's the federal government because of the fiscal priming. So, those are where really the jobs are, those are where we have gained jobs relative to the pre-pandemic level. But in all the other industries, we're still trying to recover those lost jobs. But just to put this in context, at the height of the pandemic, 22 million people lost their jobs. 22 million. Now we're just 7 million off. So that means that 15 million of those jobs have been recovered. This is a very interesting chart that shows that if you see here job openings, that continues to go up, whereas the number of employed continues to go down. So there's just that like 1 million gap, right, between job openings and unemployed. So not much if you're unemployed, whereas before you had to compete with fewer jobs. Now there are more jobs available there. And in fact, for professional and business services, the number of job openings has now outpaced the number of unemployed. So there are more job openings out there than people unemployed. And, that's going to lead to higher wages as people compete for those fewer unemployed. And, that's anytime you have higher wages, that's good for your housing market. Where are the jobs? This is just to show that California as a whole is still 7%. Employment is still 7% compared to the level in March, whereas you had Idaho and Utah, right? Idaho, you have Boise, Idaho. Utah, you have Salt Lake City, Ogden, those booming areas there. And, some people who are moving out of California are actually going into these areas that are less expensive. And I wouldn't dwell too much on this, but jobs in San Jose, Santa Clara Metro are still down by about 160,000, but they're recovering, but we're still short of jobs. And those are probably also not your tech jobs, but your jobs in food services, your Starbucks, what else, your retail stores. And, those are really, in terms of the housing market, those folks will not be your typical home buyers. They will be your renters. So if you're in the commercial real estate and you're renting, or you're in property management, then those will be your market. And so they will, continue to remain as renters for quite some time. There's still the eviction moratorium. And there's $45 billion in federal support to assist landlords and renters. So where most people are unemployed will tend to be renters, whereas the people where jobs or industries are growing, the professional and business services will tend to be your home buyers. And I just wanted to show this too, because this will impact your, if for your viewers who are also into commercial transactions and into office sales. So 55% of your tech workers are still teleworking. That is about 4 times the share of people who were teleworking prior to the pandemic. Among all types of jobs, just about 6% of the workforce was working from home before the pandemic. Now we're at 18%. I mean, it's going down, and there's an issue. The issue is, will the trend from working from home continue? And of course, that's a very broad question. Like what do you mean? Is it gonna continue and end at this level, or is it just gonna stay flat? And I think the trend that we're seeing is, for now, it's people are returning to work, although much more slowly in computer and mathematical, but they are returning to work. But on the other hand, especially for tech companies, they are offering work from home as a kind of an employment policy to attract workers, to give their workers some kind of work-life balance. Although some people are saying, I can't maintain my work-life balance, right? I'm working from home also. But I think that kind of a shift, and Microsoft already started with this, right? They're calling it not working from home, but like a work style, work lifestyle balance. So I think that will continue to be offered. So I think we probably will not get to, could be we might return to 12% or maybe a bit higher, like 20%. But I think from the looks of it, people are still returning to work, and that's good for the office sector. So let's get to the housing market. Housing market that, as you know, dipped last year. The nadir of that was April and May. Then we started going back up, right? We had to recover, but now we're kind of like slowing down again. So it seems that we have topped out at about 6 million. It's slowing down, but this 5.85 million and the home sales that we've seen in January to April are still 20% above the level we saw in January to April of last year. Of course, we're capturing also the March and the April, right, where sales fell here. But the year-over-year growth in January to April compared to here is about 20%. But it does look like that the housing market now is trending towards a level of home sales nationally that is below 6 million. Mortgage applications, this was what I had to change. I had, they were dipping, but with the news released, I think today, we do see it's flat. It's still below the January figure. And by the way, this is the index. It's just an index. Where 1990 equals 100. The home purchase and refinance applications in 1990 are equivalent to 100. So that means that compared to 1990, the index is now 300. So you now have 3 times more purchase applications now compared to 1990. But what's important to look is the trend. And you can see that, for purchase applications, which is this dark blue line, it's kind of like flattened also, but at least it's not declining. And that's because mortgage rates started falling again to below 3%. And if I'm a buyer, right, I'm a home buyer and I have cash, and I know that next year with the economy improving, Chairman Powell will probably start to think, and with inflation rising, well, he did say that, by the way, the policy they're following now is what you call the average inflation targeting policy. So even if inflation rises a bit above 2%, because we were below 2% 2020 and in early part of this year, so they have a little bit more room still to go ease monetary policy. So I don't expect a rise in mortgage rates this year. I mean, some uptick, but it won't hit 4%. Our chief economist, Lawrence Yun, is forecasting about just 3.5% by the end of the year. But if you're a home buyer next year, you expect higher rates, and you have cash now, right? And you know that home prices might just go up, continue going up because of the millennials coming in and buying into the market. Might as well buy a home now. So I think that is what is also driving the housing market right now and home purchase applications. And this is just data that shows the type of financing that borrowers are obtaining. You can see that they're actually going for your conventional rather than your government loans. And although there was an uptick in May, but from our realtors where we survey every month, we often hear them saying, if it's a FHA loan or a VA loan, lenders won't even, or the sellers won't even look at that. Because if you're competing with someone because if the appraisal comes below what, Dave is going to approve, right? Then somebody offering just a 3% down payment won't have enough, that they won't probably have enough cash. So that deal is going to fall through. Whereas somebody offering 20% down payment, might have more resources. And in such a tight market, sellers just also want, assurance that their home is going to also, sell, doesn't fall through, and it'll sell quickly. So it's the conventional market that is stronger and picking up than your FHA lending. Record inventory, why are prices rising? And we all know this record inventory nationally, the inventory is just at about 1 million, around 1 million homes. Never have seen this. It's 4 million during the Great Recession. And even if we go back to 1962, 1968, when NAR started collecting single family data, we've never hit about 1 million. And homes on the market are equivalent to about 2 months of supply, way below the 5 to 6 months of supply that we should be seeing in the market. So there it is, house prices are rising fast. Oh, sorry. And I did put here the core logic of 12%. Actually, core logic is kind of outdated, Dave, because they're using 2 months data and they're lagging behind what NAR is producing. So NAR, as of today, NAR has April, and this is really the median existing home sales in April, whereas core logic has, I guess this is also maybe April, but they're actually basing their home price on the past 2 months. Although this is the CoreLogic index is reflects an apple-to-apple comparison, meaning that they only look at repeat sales. So if you're a home buyer and you want to sell your home, then you can say, yes, my home as it is appreciated by 12% based on the CoreLogic, because it's the house that was resold. Whereas the NAR median price reflects the mix of homes in the market, and the mix of homes in the market is now at the upper end of the market. So that's why you're seeing, actually, I'm sorry, this is not 16%. This is now 19%. In April, the median existing home sales price is up 19%. And this is data from Realtor.com. In May, 78% of those metro areas, almost all of them are showing price increases, and all in California, all the metro areas are showing price increases. Now, I think San Jose, Santa Clara metro area is this one, but the Riverside, I think, and then below, I don't know what that is. I think this might be San Diego, and then the areas closer to San Jose, like Sacramento. So the areas outside of your high price areas are the ones showing a higher price appreciation. The highest price appreciation I checked, this was Boise, Idaho. That's 33.5%. And these are your Utah markets also, very strong price appreciation. But you can see that almost everywhere, you got strong price appreciation because of the lack of inventory. And there it is. What percent of metros have listings compared to a year ago that are up? None, almost none, except for Utica, New York. All metro areas have active listings in May that are below a year ago, as much as even 78%. Nationally, I think this is about 40%. And I think in your area, right, Dave, you're probably seeing like 40 to 50%. Although I was surprised, I did see that you mentioned like 1%. Active listings are up 1%. So I think that was a bit good news to me. Not sure, but that was what I
year
saw.
over year. I was comparing against 12 weeks ago.
Oh, 12 weeks ago. Got it. Okay, so kind of like 3 months ago, right?
Are we trending up? We trending down for right now?
Okay. But a year ago, it's still low. Yes. Okay. So this is a year ago. And as I said, inventory, there's no inventory at the lower end of the market, but hey, you guys, your homes are $1 million. You've got inventory. People are selling homes there, also there, right? Where are homes being sold? Because there's lack of inventory at the low end of the market. Most sales are already above 500,000. That's why the median price is now about 350,000. A year ago, it was like 250,000 was the norm. Like in your head, when you start doing graph of the back of the envelope calculations of home prices, you put 250,000. Now it's not 250,000 anymore. We're at 350,000. That, but again, I guess in your case, whereas your back of the envelope calculations before is probably $1 million, that's 1.8. Again, days on market down to just 17 days nationally. Of course, we have home sales that are selling, 5 days or a day, just a week on the market. I saw like you had 7 days for Santa Clara. So anyway, the bottom line is properties are just selling more quickly than they did a year ago. Like nationally, it's about 10 days faster than a year ago. And there's more competition. And nationally, 5 buyers for every home sold. And we hear from our realtors, they could be like 20 buyers lining up, but on that home that's sold. Because what may happen is, they're lining up, but then they see that all those people are already lining up, and they know that they have to bid. They don't make an offer anymore. About a third of buyers who decided not to make a bid is because they just don't want to compete. That's what our realtors are saying. So they may have looked at it as a realtor. Are there any bidders out there? Well, yes, they are. Sorry. So they may be interested, but at the end of the day, they don't bid. But anyway, we have 5 offers for every property sold, and that's rising from just about 2 to 3 a year ago. Another impact of this tight market, rising share of cash buyers. You know, as they say, cash is king, and if you can offer cash, you know, why not? Of course, the interest rates are so low at 3%, but I guess if you have cash and you really want that home, you know, some people are offering that. So a year ago, that was just about 15%. And we're also seeing that a higher fraction of buyers who are obtaining mortgages are paying 20% or more. That's up to about 50%, whereas in 2011, just about 40%. Now you kind of like, you put down 20%. What else are they doing? They're waiving appraisal contingencies, which, and the important one here is inspection contingency, right? I mean, I even read a comment where they said that they waived a termite inspection contingency. My gosh, can you imagine? You buy a home and it's going to be eaten by termites. You know, I think we should advise, you know, our buyers to please avoid waiving this inspection contingency, because, you know, you want to buy a home that's worth what you're paying for. You know, I guess maybe some are waiving the appraisal contingency because they have cash anyway. So, okay, this doesn't matter as much, or the financial contingency for people who have cash. But again, this is just an indicator that those with cash, the financial wherewithal, those who are in the upper income are edging out your first-time buyers who may not, you know, have this cash or a higher down payment. This was the slide that I had to put, but it was cut. But you do see here that one of the strong drivers of the housing market now is vacation home sales. Used to be that vacation home sales made up about 5% of the market. In the first 4 months of this year, that's up to about 7%. And if you convert that to number of homes sold, in past years, it's about 300,000. Last year, it was 310,000. And now in the first 4 months, on an annualized basis, vacation home sales are up to about 412,000. And so compared to a year ago, that's up about 57%. Existing home sales overall are just up 20%. So there's this strong demand for vacation home sales. I guess it has to do with, you know, just having a second home to live in where you can work in, or maybe if the pandemic hits again, or you have that flexibility to work from home, you know, you could work from home in that vacation home that you bought. Or if you're not staying there, you know, you could rent it out for kind of like Airbnb or Vrbo, or, you know, as a short-term rental. But Dave did mention that there are issues surrounding that right now. I'll leave that up to Dave to discuss. Just to show that housing starts are still trending below. Well, they picked up a bit. Today's news, housing starts were about 1.6 million. They did increase in May compared to April, but housing permits fell. So we really need to build about 500,000 more homes every year just to address this housing supply shortage. But, you know, that's not easy, right? Because we have right now, lumber prices are so high. We're also dealing with employment shortage. We lost 1.5 million construction jobs during the Great Recession. We have not recovered all of that. We're still 500,000 short, whereas your population has increased by 10%. So mortgage rates, they're still low right now. Surprisingly, even if inflation picked up to 5% in May, they didn't rise as much. They're at 2.96%. And I guess it's because some investors are also moving into bonds. So that's driving down the rate on 10-year bonds, because they're buying bonds, so the price of bonds is rising. And when the price of bonds rise, there's an inverse relationship with interest rates, or the interest rates fall. And so the fixed rate mortgage is following that trend. But again, so we'll see what will happen to inflation. The Fed is saying it's transitory, and And so there it is, 5%, and they're saying it's transitory. And yes, some of that because people are starting to travel. You can see that hotel and motel stay prices are up 8.8%. Gasoline is up 9.3%. Guess maybe people are buying motor vehicles. And there it is, your rent, but your rent is up 2%. Others are other costs like clothes, still down. Meat is also increasing right now. But we must also remember that people had a lot of pent-up savings. And so I guess the Fed is saying this is transitory, that money is going to be spent, hopefully some of it will be spent on buying a house, right? Which doesn't get into inflation. House prices don't factor into inflation, the rent does. But they're thinking it's going to be transitory. But, with oil prices rising also, and then with the employment falling, there's always wage pressure for wages to rise with employment going, with unemployment going down. So we will, I think, continue to see inflation go up through the year. And again, our chief economist, Lawrence Yun, is forecasting inflation to rise to about 2.5% this year. But as I mentioned, because inflation rates were low, the inflation rate was low a year ago, and the Fed is doing an inflation rate targeting, they might still not raise interest, the federal funds rate. So until the Fed raises the federal funds rate, you won't see an uptick in mortgage rates. And as I mentioned, some inflationary pressure for homes is your lumber. Actually, this is the most recent data today shows lumber prices are now up 151%. So that's going to go into your cost of homes. Housing forecast, so there it is, mortgage rates 3.5%, home sales 6%, with home prices still going about 7% this year. Although this could be higher still, I think this is a conservative one, given that we're seeing 20% year-over-year growth. Now, just a little bit on commercial. While we have a good story, we have, booming housing market. Unfortunately, commercial is down. So for those of you who are in commercial sales, deal volumes are down by about 30%. Office leasing, the most important property sector in the Santa Clara area, you got negative net absorption right now because people were able to work from home. So vacancy rates are up 16%. And so, so even for retail, we didn't see that much uptick in vacancy rates, certainly not for industrial properties because of the e-commerce sales that's boosting the demand for industrial warehouses and for apartments. As I mentioned, your people who are unemployed tend to be renters. So we didn't see much uptick in vacancy rates for apartments, warehouses, and retail stores. So if you're in that, a property manager catering to that type of the market, not a lot of uptick in vacancy rates, but it's the office market that's struggling right now. And especially look at the sublease, right? Because your workers are able to work from home in Austin, 2019, only 2% was being subleased, 2% of their space. That rose to 9%, right? And then the green line is San Francisco. And as I was saying here, San Jose, I didn't see that strong uptick. So not a lot of office space. San Jose and Santa Clara doesn't seem to be having that much problem in office space vacancy than do San Francisco and Austin and New York. Vacancy rates forecast, where we continue to see them going to be elevated because of the working from home and because of the pipeline that is already there. And with that, thank you so much.
Thank you so much for that presentation. Truly appreciate it. It was not boring.
Oh, thank you. Oh gosh, I thought I was gonna be boring after Dave.
No, it was very lively, a lot of really good information. And we were just talking about some of these things earlier. We were just talking about some of these things at a meeting earlier today. So very timely. There are two questions in here. So if you have any questions, we've got about 3 minutes left. We may be able to go over just a little bit, but there's two questions in here for you. The first one is regarding anticipating rise in interest rates. With the federal debt being what it is and rising, wouldn't you think the Treasury and Fed would want to continue low rates to make financing of the Fed department more affordable in the long run? Hence, continue artificial low rates despite inflation fears.
If I may just start, and then Dave can also put in his remarks. Well, the Fed doesn't, that's not the indicator that the Fed is looking at. Really, the Fed is looking at employment, is the economy moving towards employment, and what is happening to inflation. And they want to emphasize that that is what they're looking for, so that people know and expect that this is what I'm looking at, and based on these indicators, you know how I'm going to act. So I don't think they'll say that, hey, I'm going to keep interest rates low even when inflation is up, just because they want to pay less interest rate on their debt. So I don't think that's
statement is
that's
out,
part of the
'cause it is
mentality.
11:30 now, and they said that their inflation expectations are to be at 3.4%, a full percentage point higher than what March projection was. And even with as you had mentioned too, even with the raised forecast this year, the committee says that the inflation pressures are transitory because it is a year-over-year measure, and things were so far off in regards to COVID, right? So yeah, they're going to let that number stay high. They publicly now said 3.4%. Once that news went out, the Treasury bill went up 5 basis points at 1.55. Mortgage-backed securities at their worst levels dropped off at about 0.3%. So said another way for the realtors in the room, if I quoted you before they spoke and I was at 0 points, it's now at 0.3 point. So that's how much it moved. So in dollars and cents, if I bought that average house for 1.8 and I put 20% down and got a loan of 1.4 times 0.375, the difference today is $5,000 from this morning to right now of how much I'm paying in points.
Not much.
That's what just happened in the last half hour. Can't get more up to date than that.
Not a lot. And I do, again, Dave's got something at 11:45, so we'll ask a couple more questions. How bad is the individual investors and corporate investors buying up single family homes in today's market of short inventory?
So I don't have numbers on this, and I don't want to speculate. I mean, to be frank, that's a number also that we're trying to get a grip on, like how much. I think, well, actually, you know what? We do have a number. It's about, they're holding about 500, no more than 500,000 single family homes, compared to an inventory of single family homes, I think of about 70 million. So it's not a lot, although of course, you know, with a tight market, right, it adds up to the competition. I wish they would build more, and they will build for people to own rather than to rent. But like if you're a REITs, right, so that's where they get their cash flow, you know, from the rental. So it could be better. I guess my answer is I hope that they do build homes and for home ownership. But on the other hand, yeah, I guess there's a market too. You know, not everyone can be a homeowner, so it's also tight at the rental market.
Is there a slowdown in the entry level single family home nationwide?
As I said, that chart that I showed, yes, when compared to the second half of last year, when we had to recover from the slump and the pandemic, we saw both condominium and single family sales increase. So they're normalizing right now. But compared to about a year ago, they're still ahead by about 20%.
Okay, last question, and then Dave's going to give us that answer with the numbers from January to now. So the last question, and I don't know what this is, so maybe you will. Isn't QE part of the effort to keep mortgage rates down, as well as a way to finance the Fed debt as well, despite the private money from bond investors that is usually the main driver of the 10-year bond market?
Yes, QE is part of the toolbox of the Fed to, yes, lower interest rates. And why are they doing that? Again, there are two objectives, right? To address unemployment rate, but also to keep inflation down. So remember, in the first part of my slide, I said that 7 million people, 7 million jobs are still lost from the pandemic. We have not recovered that. Unemployment rate is about I think 6.5%. We were at 5.3% before the pandemic. So the economy has not fully recovered in terms of employment. And so that is why the Fed is still trying to keep mortgage interest rates low, either via QE or through the changing the Fed funds rate.
So I just thought of a question when you talked about unemployment, and this is my last question, I apologize, but I just read an article that there's a San Jose restaurant that was having a hard time finding employees. And I personally know of somebody who had a small business and their employees didn't want to work because they got paid more money on unemployment because of the bump that they were getting. Do you see people kind of writing out this unemployment as long as they can because they're making more money? And do you think the government will start to crack down on the refusal of work when they're called back?
You know, there's a survey called the U.S. Census Bureau Household Pulse Survey. And that survey showed that only 11% of workers who did not want to work, of those who had not worked at all in the past 7 days, only 11% said they didn't want to work. And that could be related to the unemployment insurance. But for most people, they weren't able to work because they didn't have a job. So I'm saying that, certainly it's happening, but it's not the main reason why people are not working. The main reason why people are not working is because they either they don't have somebody to take care of their kid right now, right? Or also maybe their business was closed, or maybe they don't have the skills. So there's that disconnect between the skills that are needed, and maybe they were into the hotel and accommodation, and right now that's not there. They may not have skills to do, I don't know, something else. So there are other factors. So I would say that it's happening, but it's not the main reason why people don't want to work.
Awesome, thank you. And Dave had
something. Can I add on to that real quick, Jody? Just to say, we're in a very unique market. I don't think very many people who work in the restaurant and the hotel industry can afford to buy a $1.8 million house. So in our marketplace, I agree that is the biggest percentage of the people that are out of work. It really has no effect on our real estate. Right. From a national level, it is something that's looked at, as the question was asked, on what the Fed's doing and what their target is for inflation. And for lawmakers, are they going to continue to give out all this free money or whatever stimulus you want to call it, whatever you want to label it, still taxpayer money. So as far as when it comes to local housing, I don't think it will have any impact on us. Interest rates obviously would, but they're going to continue to do the QE because we're already at a zero interest rate. They can't lower it. We're not going to go negative like some other countries have. So they have no choice but to do QE to keep the economy going. And they are a little concerned about the inflation, but they think it's on track because it was so bad last year. So it's tough. It'll be a tough road for the next year for people to kind of model. I mean, you're the economist, okay, but it's tough to see what the model is going to look like for next year versus this year, because when we're averaging the numbers, like CPI as an example, is a 12-month average. And when you take off a very negative number from the prior month or 13 months ago, and you add a new one that's so much higher, that average shoots up.
Right. So it's now closer to 2%
going, okay,
already.
We can take on a little bit more inflation right now.
Yes, yeah, it's actually already moving towards 2%. And to me also, I mean, they keep saying it's average inflation targeting, but they never said over what period. I never read in their statement over what period. But over just a rolling 24-month, you're right, it's close already to 2%. So that is why, and because interest rates matter so much in your market, that's the most important thing. I mean, interest rates can only go up, right? I don't think they're going to go down. Interest rates can only go up. So, if you can buy a home now, buy a home now.
Awesome. Thank you. Thank you
I've
both.
got those stats to throw in the chat in case anybody wants to copy them. Someone had asked, hey, what's January versus now? Average close price was 1.8, as we already knew. It was 1.5 in January 2021. So we're up 20% by average close price as far as dollars, right? 296,000 for what all our closings were in January versus all of our closings in May. Units were 1,022, as you already knew. 575 closed in January, which is typical. No one really buys homes in January. Our busiest season is from Super Bowl Sunday to Mother's Day, right? So we already know that number was going to be differential, but it was off 56%. Percentage of asking was 108, as you already knew. It was 103% of asking in January, almost 104 at 103.8. Days on market shrank from 21 days on market down to 11 for the month of May. And then I put my email address in there in case anybody wanted my slides. I don't know if Gay is making the slides available to SCORE to send out, or
yes, I will send them to Jody.
Perfect. And then if you want Dave's slides, send him an email, get in contact with him, and then I'll have everybody Gay's slides. So we went over a little bit. I want to thank you both so very much. I hope everybody found this informative. I got a lot of great comments in the chat that this was amazing. And maybe we'll do it again in a few months and just see where we're at and what things are happening. So thank you both so much. Thank you everybody for joining. And we'll see you guys all later.
Okay, thank you so much.
Thank you, Jody.
Thanks, Jody. Thanks, Dave.